Good afternoon, everybody. This is Christian Thwaites of Brown Janikowski. Welcome to our monthly market update, June the 8th. We try to cover some topics today, but the big hot topic of the time is, of course, is inflation. I'm sure you've seen a lot of the comments about whether they're going to be temporary or slightly more permanent. And there's kind of two extreme camps. One is the sort of, no, it's extremely temporary and it will go away within a very short space of time. And on the other extreme, there's a lot of flag waving about this is a return to the 1970s, where we're going to have very big inflation. The Fed's sort of out of control, and we've seen already some increases in the CPI, which should be a big warning to us. Now, of course, the truth never really lies at either end, but I very much tend towards the position that the Fed, and also credibly Janet Yellen, has taken, which is that the inflation is probably transitory, in that we've come from such a period of lockdown that there's inevitability some supply constraints in the system, and they can be anything from not enough container ships leaving Los Angeles and going back to China and getting back in time, to the semiconductor market, used car market, and there's plenty of other examples where the supply has been severely disrupted over the last year or so, and it's coming back slow, some faster than others for sure, but that supply imbalance will gradually revert to norm, and indeed we'll see inflation level off. Anyway, I'll cover some of that as well, but that's really pretty much the commentary is some version of that every day, whether or not we're got the actual CPI numbers coming in tomorrow, or the unemployment numbers from Friday, or something called the job openings number, which came out today. Nearly everything is in this under this guise of is the inflation transitory or something more serious. So let's just kind of go through some of that and kind of figure out where we are, approaching the midpoint in the year. I mean, the economic growth has definitely bounced back. We saw an 8-9%. 7%, I think, print of GDP in the first quarter, and the second quarter is going to be at least that, 9 or 10%. The first wave of the economic bounce back was very much in goods, which if you think about how people were constrained in their mobility and their spending choices, their spending options, it made sense that a lot of people went out, and bought goods, whether it was a Peloton machine or an upgraded router or an upgraded computer. But essentially, most people were buying things either online or where they could directly, and it very much pushed up the demand for goods, and indeed the goods deficit and the trade deficit. But it's turning more and more towards services. The problem with the services is that still many of them are constrained in some way. I mean, restaurants in most part of the countries are not operating at 100% capacity. People are still concerned about going out for the big service providers, everything from hotels, cinema chains, other kind of leisure goods, sports, and the cruise industry, which is not even remotely back to where it was. But anyway, the services, I think, will start coming in. You'll get this crossover. It's already happening between people buying goods and people demanding services. The consumer is coming back. Now, there's a natural hesitancy. It's not really the case where the barriers are going to lift and people are going to automatically say, right, I'm back to where I was in February 2020. It's going to take some time to change some behaviors. I mean, even in our county, there are different regulations by store, certainly by county, by area. So the consumer is going to take some time to kind of get back to normalcy. Yes, they've been lockdown, people have been in working from home, and they're not going to come back in a kind of V shape back to doing all the things that they used to do. I mean, I'm sure many of you have your own experiences, whether about postponing vacations, changing vacations. All these follow under the services side, which is a much larger part of the economy than the goods side. And that's right, my point 3. So a lot of these companies may not be ready for demand. They may not be able to find the people, or people are more reluctant to come back in the same capacity, or they've just been closed for a while and opening up is proving difficult. I mean, the good news is, of course, that the daily cases now is down below 10,000. Peak was 300,000, remember, just a few months ago. 140 million people vaccinated, 65% of the adult population. Now it varies from state to state. You know, tend to be the Republican states about 45%, and non-Republican states a little bit higher. But on average, it's about 65% of the adult population. Now, I don't know whether that's enough for herd immunity or not, but it seems to be enough that, you know, people like the CDC are gradually going to be reducing their standards and requirements, and that's going to be a huge shot in the arm for consumer confidence. The employment is steadily increasing. Remember, we lost 22 million jobs. Roughly, we've got all but about 8 million of those back. The April jobs numbers when we met a month ago were very disappointing, about 250,000. And we'd had, you know, people were expecting more like 800,000. They did recover for the May number, about 559,000, but it was kind of like a middle of the road number. But so far we got 65% of the jobs regained. Now, we've done that inside of about 15 months. It took well over 3 years to regain 65% of the lost jobs back in 2008, where there was practically 36 successive months of job losses. We had 3 successive months of job losses, albeit very big ones. So the job number, I think, will start to improve, and I think over the summer we'll start to see about the numbers going up from about 550,000, 590,000, what we saw last Friday, to numbers, you know, closer to 6 or 7. But it will be slow. There will be, you know, times where it's not coming back as fast as people like. But you've got a combination of the economy opening and also the unemployment benefits expire. Well, they expire in 25 states next month, but they'll expire for everybody else, the $300 supplement in September. The Fed is still very much on data watch. I mean, they do believe that that employment needs to recover and inflation is still temporary. So they don't expect them to shift much from that. They'll have to kind of see, you know, solid prints on inflation to come off of their basic view that that inflation is temporary, and everything we're going to see over the next few months is because of the low base effects. Good. So this is just a quick visual confirmation that the United States is where we were back in January. Things were looking pretty bleak. We're in the 3rd wave, but now, of course, we're way down here, and you know, this is right at the bottom end of the graph, and everyone else is sort of getting there too. This is confirmed cases. Obviously, it's not the vaccination side, so I think the vaccination rates in the United States and to a lesser extent in the United Kingdom are pretty much way ahead of the rest of Europe, and I put just these countries just as a sampling. But you can see how well the United States has come down from its peak in February. So this is soon going to go away, at least temporarily. I don't know about 2nd and 3rd strains and things like that, but for now we're at a level where the economy reopening is definitely coming very quickly. And the number of cases in the big 4 states, which represent about 40% of GDP, are obviously seeing some big improvements over the last 4 to 6 weeks. In fact, since we met, we were here about a month ago. You can see that you know, Florida, New York have actually halved. Texas was pretty low. California was pretty low already. So let's just kind of come to this inflation dilemma. If you're going to get full-blown inflation, I'll leave out hyperinflation for a moment. Hyperinflation is a political issue, not a monetary issue. So if you're talking about hyperinflation, I think you have to use that definition very, very carefully. And in the 20th century, there were probably 4 cases of hyperinflation. The most recent one was Zimbabwe. Even Argentina didn't get it, and they were having price increases of about 80%. And the other ones, interesting enough, are Hungary and, of course, the Weimar Republic. But the hyperinflation, where you're talking about accelerating inflation and going into the thousands of percent, is entirely a political choice. And so it obviously doesn't happen very often. Now, the inflation, which I think people should be thinking about, and I hopefully are, is the inflation of the type in the 1970s, where you kind of get accelerating inflation going from roughly about 5% in 1970 to a peak of about 20%. And that's obviously a major concern. Now, it's not hyperinflation, but it's It won't blow the economy apart, but it'll certainly disrupt the economy pretty significantly. So what do you need for full-blown inflation? And by this definition, let's just call it the 1970s type of inflation. Well, you need a central bank that's not really independent. At the time, the Fed was a lot less independent than it is now. It was nominally independent, but there were a couple of Federal Reserve governors under Nixon and Carter, which were, let's just say, quite malleable in their persuasions. It wasn't until Volcker came around until you really got true central bank independence. Or they've kind of given up on inflation. They're trying to fight an employment number or a monetary target. You know, that very rarely happens, but that's certainly the case in some parts in Europe, notably the UK. It also helps if you want to have inflation, you have a non-competitive or a closed economy, where there's a few price makers in the industries and not a lot of outside competition, not a lot of outside competition from tradable goods. Also, if you have a high dependency on commodity inputs, I mean, commodities is certainly a leading indicator of inflation, but just think how less dependent we are on commodities as an economy. I mean, nearly all of the top 5, top 10 companies in the S&P 500, whether oil price doubles or not makes no difference to them. They don't use it. They don't really use many other commodities. I mean, perhaps Apple as a consumer goods manufacturer has some exposure to some metals and cobalt and lithium perhaps, but really that's just a very, very small part of the final product inputs. So back in the 70s, is a different story, obviously, much more heavier industry and much more reliant on basic metals goods, as well as, of course, energy commodities. If you also want to have big inflation, it helps to have kind of structural shortages. This typically means where supply is constrained because there isn't enough competition in that particular industry. And again, that was true in the 1970s, for example, where there was structural shortage in the airline industry, and so the big companies at that time pretty much had the place to themselves and put through a lot of price increases. Now, this number 6 is actually the most important one. It's wage pressure. You can have price-led inflation, so it's the underlying prices of the goods are pushing inflation up, but the big one is where the wages pull it along, and that means that as prices go up, workers want to be compensated in real terms, so they start to ask for real wage increases, and that kind of gets you into a spiral where the wages increases, the price increases, the wage increases, the price increases. Now, this was very big in the 1970s. There were very powerful unions. The share of the labor in the economy was much higher, but in terms of who profited, whether it was in capital or profits or share owners or labor was probably getting 30-35%. They're down to about 12% today. So that's another way of saying labor is not strong anymore. I mean, outside of a very handful of industries I could barely name, maybe some in the airline, the only major unions that are strong these days are in the government sector. So, the wage pressure would have to come from with labor having not only a powerful position, but a concerted and concentrated and united powerful position. And that just certainly isn't the case right now. So, so I do think that while we're going to watch wages, I think you need an extraordinary set of circumstances to get wage pressure coming through the economy. And those are the same things, kind of unions, collective bargaining, that kind of stuff. And then finally, you kind of need a weak currency. It's not so much the problem in the US, but in parts of Europe, certainly before the euro, and Japan, if you start seeing your currency weakening, then that's going to be an added problem, especially if you've got import dependency. So just kind of move on. That's what the kind of framework. If you're going to talk about an inflation environment, that's what you need in place. And this is what people are talking about. This was the CPI number, which came out a month ago. Now I'll get another print tomorrow. My guess is probably looks something like this, about 0.77%. So what people have said is, well, that 0.77% is about 10% annualized. And that's true, it is. And the last time we had that was in 2008. But this also tells you that bouts of relatively high monthly inflation, so obviously way back here it was 1/1% in the middle of a recession, and even just before the recession it was at least as high as it is today. But you can just see that there's not a trend here. It just kind of it goes up, it eases off, it goes up, it eases off, and you get some. And these months of increases over here on the right hand side of 2020 barely get you to what you lost in those three big months there, and perhaps a little bit more. But so it kind of put this into context. You know, you see spikes, especially on a monthly basis, all the time. And you know, even if we compare it over a long period, we're still not particularly high. So I think that the headline issues are way overblown. As I said, the US has had bouts of inflation, but let's go near 100 years. In the early 20s, it was out of control. I'll come on to this one in 1944 in a minute. It's kind of unusual. And this is also a wartime one. But for most people's experience, it's kind of this, where between 71 and 81, you travel between 4 and 14%, where it was you can see in the 74 inflation it was 12, it dipped down all the way to 5, and then spiked up, and this was the last gasp before Volcker sort of got things in hand. And then since then, inflation has barely broken 2 to 3% over the long term. Now, the last number that was printed a month ago was 4.16% on an annual basis. But I would kind of invite you to look at this graph and say, does that look scarily different? We had it coming into the 07 global financial crisis. We had very much close to it a year or two after the end of that. So again, these are not unusual, especially this is the headline inflation, so it's got the very volatile energy numbers in there as well. So again, yeah, you'll see headlines, it's the biggest print since, and they'll give you some number from a long way back. But then I'd say the US has had plenty of bouts of inflation, has recovered from all of them, and investments have not really suffered during that time. And this is what I think we're fighting. This is the headline inflation, and then stripping out the core energy. But also importantly, it's this PCE inflation, which is the two blue lines, the hashed one and the solid one. This is what the Fed's looking at. And so right now they're at about 3.5%. Again, they've been that high plenty of times. 2012, Fed didn't really do anything. Certainly didn't do anything in 2008, 2006. You go back a little bit, 92, 94. So there are plenty of times when it pops up for a bit, but it doesn't really stay there. And I think the Fed is thinking that this is probably a replay of exactly that playbook. So, they're going to be keeping an eye on inflation, and part of what they're doing is we need to make up for this period where the PCE inflation barely got above 1.5%, for nearly 2 years. So part of this is a little bit of catch up, but again, this also has some temporary price changes in there as well. But the point about this chart is that, look at this. This is a nearly 40 years sort of move down towards lower inflation. And if you kind of go before the 1970s, as we just did, you can see that this is an aberration. We just don't get that kind of inflation sticking around the economy for very long. And interestingly, there have been supply shocks before. This is inflation in the 1942. So there are some parallels here. So what happened was that there were price constraints in the war. Obviously, a lot of the economy was turned over to a war footing. So there were constraints on consumer goods and on consumption generally, and there were also huge incentives for saving. We also a time when the country was running big deficits. And then it was also a time where there was this thing called velocity of money, which is essentially how much a dollar changes hands in the course of a year. If I get $1 from my employer and don't do anything with it, the velocity is 0. If I spend it, and then someone then goes and spends that dollar on dollar, you're getting velocity up to 4 or 5 times. And normally it's been a relatively good rule of thumb that the more that money turns over, the higher the inflation rate. The velocity is quite low right now. It's very high back here. And so what happened, this is when the price of a car between 1945 and 1947 doubled. And that was purely because the industries were moving from being closed, which is the same as being on a war footing. To the analogy today, they were doing tanks and landing craft. Now they're doing cars, so there were few of them around. Just like a lot of the major industries were closed a year ago. So inflation took off, and then very quickly subsided, and wages didn't follow, and there wasn't a big expectation that inflation would continue. So it was a catch-up after a period of very constrained demand. I think we're more likely, the parallels to today, well, they're never completely exact in history. They're more like this than they are in the 1970s, for sure. This is a change from a wartime economy with plenty of supply for goods that people didn't need anymore. You don't need any more B-17s, B-29s, Sherman tanks, and so on. But you didn't have enough of what people did want, which was household goods and automobiles and so on, and housing. So all that had to kind of move to a new footing, and it did. And so, but in the short term, there are a lot more people with money to spend than there were things available, and that very quickly sorted itself out. So we've kind of been there before too. Now on the inflation side, again, so sticking with it, this is another one where people have commented, and I think not unreasonably. This is where the Institute of Supply Management, this ISM, goes to manufacturing companies, to go to service companies, and one of the questions asked is, are you seeing prices increase? Not are you raising prices, but are you seeing prices increase? So if you're running a restaurant, are you seeing the price of your core inputs going up? Food, wine, whatever it is, bottled water. If you're a manufacturer, you're seeing the core inputs of your business going up. So if you're making tools, it's cost of steel. And so this has spiked up quite a bit. So especially from its lows. I mean, back a year ago, the manufacturers, only 35% of them were saying, yes, we're seeing increased prices. Now 88% of them are. Doesn't quite work like that, but that's roughly what, but you can see the direction and magnitude. But again, my point is, you've been here before. You get here in times where, whether it's in the middle of the recession here, or the back end of a recession, a couple of years after, or right in the middle of it, you kind of get these moves, every now and then, and it can be through a number of reasons, mostly on the supply side. And I think that's what's likely to happen. I just don't think that while plenty of companies are not happy about this, they're not going to necessarily pass them off into final finished goods prices. Or if they do, it's probably likely to be a one-off. It's not likely to be permanently inflation. So that's one part of the debate. Another one is that, yeah, sure, some of the inflation is very much supply COVID-19 related. This is lumber, which you've probably seen. This is the reason housing stalled out a bit, because the lumber prices just skyrocketed. I've talked about this before. This was a direct result of the tariffs going in on Canada on Canadian lumber. It takes 7-8 years to grow a tree to the point where it's harvestable as lumber. So you can't just sort of replace the constraints in supply overnight. But also a very big point was that the lumber mills were very skittish about putting a lot of capacity and workers online after the GFC, because they got so badly burnt. So they were kind of slow to do that in this period, 2010 to 2019, and obviously they closed down a lot in 2020. So some of it's coming back online, and some of it is just the fact that in lumber, because of the import constraints and things like that, went up, and there was a huge supply from housing. So if you're a house building and you've contracted to build 7 units on a street, that takes a long process, and you need that lumber, and you're going to pay for it, whether it's $800 or $1,600. You're too far down the line to give up and say we'll postpone this. So the demand for new housing was quite robust in 2020. So I think, again, this is something which will eventually sort itself out. Another one is copper. Same issue here. This whole area here was China going bonkers on infrastructure and buying copper. There's a lot of recession periods in here. But that too, copper supply adapted to this kind of price level where there wasn't a huge demand for it. You can remember U.S. economy for most of this period never grew much more than 2%. And then now it's sort of coming back, and guess what? There's the guys who are providing the copper and the supplies are being caught short a little bit. Copper is not in short supply in the world. It just takes time to open up a new mine and go get it. But you can again see this kind of short-term spike in demand. And sure, some prices after openings have increased. So this is just an index of here's the black line, which is the car and truck rental. This is a weird market because this is basically companies like Hertz last year who were in financial trouble anyway. They were leveraged up to the eyeballs, held by a private equity firm, had gone public with a heck of a lot of debt. Suddenly found they weren't operational, so they started to sell their car rental fleet, which is why we saw used car prices dip. Now they're back in business. Now they're not under any constraints to moderate prices if they don't have to. So I've heard some bad scare stories about car rentals prices, which have just skyrocketed. I think in the island of Hawaii, someone told me that they're in the hundreds of dollars a day. So these are companies which no one's going to put up with that for long. It's just you make your vacation bankruptable event. So eventually that will kind of come into balance. But in the meantime, people are slightly more on the move than they were. They're moving from a dead stop to gradually increasing. I mean, airlines are up to about 75% of the capacity they were pre-COVID. So you can sort of track the car rental market somewhat similar to that. And they've been able to jack up their prices. And then the used car prices, you can see that green line, they've generally been trending down. So a used car price, if it was 100 back in 2001, it got as low as 80 in 2009. It was around about 85. So it was 90. So it was a deflationary product. Well, look at that jump from about 90 to 105. That's the demand for used cars taking off last year. Again, that's people moving. The fact that the new car market closed down for about 2 or 3 months, and that's people sort of just generally trading up. They probably need bigger cars because they're having to do more at home, or they need a second car. So that's why the used car market took off. And used cars are much more prone to inflation than new cars because it's a finite good. There's only so many new cars around. If there's a big demand for them, they've got to come from an existing pool. Whereas if demand went up a lot on new cars, car manufacturers would just increase their volume. So I don't think that's going to be a major problem. And the final one you can see, the blue line, is the airline fares, which are higher than they were. You can see they just plummeted. They're probably going to get closer to what they used to be, which was, roughly they increased about 2 or 3%, but they're not there yet. And this is very much as the economic theory would have it. I've written about this in the blog about, the two components of inflation, things that are sticky and things which are not sticky, not flexible. So the sticky price inflation is everything to do with gas. You can see the gas station prices might change their prices 2 or 3 times a week. And that, whereas the things that don't change very often are, contracts or insurance contracts and things like that. Or the famous one is the coin-operated laundry. It takes a long time to sort of reconfigure the coins to accept, a higher number of coins. So this is very much as economic. What we just showed you was exactly as economic would say. The products like energy related and some fresh fruit will go up because they can change prices much more often. Whereas the blue one, the more sticky prices, is just sort of going along and pretty much what it always has been. So again, I think we have to wait for this. If the blue line starts creeping up, and again, it has in the past, then that's a bit more of a concern. But at the moment, it's just not there. House prices. Now, this is the house price inflation, and how you measure it in the CPI, the owner's equivalent rent. And it's because there's a shortage of houses. The US has never got back to the supply level of houses that it did in 2008. And as a portion of the population, it's very, very low. So the number of new houses per working person has declined enormously. Now you can put this down to house builders being skittish. It could be also because certainly around California, it's very difficult to get the permits to buy new houses, build new houses. But basically, and people are living longer in their houses, so even the used existing house market, home market isn't growing very robustly. People are staying longer. They might have in the prior period died earlier, or they might have moved into nursing homes or something like that. They're staying in their houses for longer. So the supply level on the housing side is pretty bad, and that's why the new residential sales have popped up, and there's definitely some house price inflation. Now I think it'll start to go down because I think it's taken the first wave of demand, and we're also seeing higher mortgage rates. Yeah, so just on the housing prices, this is the index of the home prices starting in 1975, so they've gone up by a factor of 10, and in real terms, almost doubled. So housing is a relatively good bet against inflation, not as good as the S&P. This is what housing would have done. This is inflation. This is the S&P, and it's price only. If we included total return, it'd be off the charts. It'd be like another 400 or 500. So just remember that if we do get sort of any increased inflation, stocks tend to be quite a good protector against that. Yeah, I also sort of went back to the 1970s, and unfortunately, the Case-Shiller stuff only goes back to 1975. But there are plenty of industries. If we get into a period now, I don't really believe that we're going to see a big inflationary time. But if we did, it doesn't mean you kind of give up on investing. I mean, there's two extremes. If you go into property and real estate, you probably do quite well, which is because you get an inflation-indexed rental income. And also you don't want to be in long-term treasury bonds because they've obviously got a fixed coupon in inflationary terms. That's probably not the best thing to have. So between that, you've got all sorts of opportunities and choices. I mean, here I've just thrown up here's obviously the big one, the energy was, went up by a factor of 18 times, whereas the S&P went only up about 1.5 times. And didn't keep up with inflation, but certainly commodities did, and all these other sectors as well: property, materials, agricultural stocks, food stocks, some retailers, and tech. So, this is not a case of if we see inflationary times, we have to get out of the stock markets. It's if we see inflationary times, we have to be more careful about what sectors we invest in the stock market. We've also seen some wage increases, but again, I put the wage increases year on year on the leisure and hospitality and the retail, trade, and transportation and warehousing. So leisure and hospitality, we know that used to be a 16 million people industry. Now it went to 12, back up to 14. Transportation, obviously, things like trucking and so on have been in high demand. Not a lot of truckers. That's not a job which people have been signing up for. So some of the wages have increased in those. But again, I have a hard time seeing this as being a lot of wage push inflation. So the hourly earnings of retail trade, yeah, they're up 4.7 year over year. But there's a lot of noise in here because people fell out of that market, so the people that were left looked like they had pay increases. They hadn't, but now you've got more people coming back into the retail market, and so some of the wage increases have been a little higher than the average. But again, I would say this is, we're not going to see this kind of take off because normally this is an industry where there's plenty of labor around, and the wage increases are usually lower than they are for the average. So again, probably only temporary. And this is the big one, the employment costs. Now, these only come out quarterly, whereas the average hourly earnings come out monthly. You can see what's happened there. The average hourly earnings, we talked about this, we're up about 8% year on year early last year, but that does not mean that people got an 8% pay increase. That just means that people at the bottom strata dropped out of the market, which meant that the people remaining had looked like they would had pay increases. And it's the reverse now. As we get more people coming in returning to market at the lower ends, at the lower paid jobs. It looks like they're coming into the workforce and it looks like they're dragging down wages for everybody. So that's a bit of a misleading number, but 1.98% is nothing to worry about. And this is what employers are paying, 2.7. So again, until that number starts moving, back here, we saw it at 3.5, and we got absolutely no inflation in all this time. So you've got to be careful that even some of these things don't translate into higher core inflation. The unemployment numbers, we mentioned those briefly, they are coming back. The black line is really the best indicator of underemployment. The headline unemployment numbers has halved, come from about 14 to 5, and steadily decreasing. But this is the number which really tells you much better how much slack there is in the economy, and that hasn't dropped nearly as fast. So it's about 10 or 11%. All right, people are either not employed or not working as much as they would like. They'll start to recover. Jobs are out there. We saw the job openings number today. Now they're a month behind. So these are April numbers, not May numbers. But it's interesting. There's about 9.2 million job openings. About 9.3 million people unemployed. So theoretically, down in this ratio, you've got a job opening for every person who's unemployed. It was also about 1 before the pandemic, but the numbers were much lower. There's about 2.5 million job openings, about 2.5 million people unemployed. So at this higher level, it still shows that there are job openings. And so eventually those people who are unemployed should find their way into the job openings, but it's not a direct match. It doesn't mean that you have, you're unemployed and you have a job opening just down the street. It might be in an industry which you're not skilled in or in a place you can't get to. So eventually this will kind of get back into balance, but the demand for labor is out there. If we saw no demand for labor, then this recession would be going on much longer. But the demand for labor is certainly out there. That's another one just showing the wage trackers. This is the Atlanta Fed goes out and does a 3-month moving average. We're converted a 3-month moving average on wage tracker. There's nothing there, nothing to see. I mean, wages were sort of gradually increasing up here as the economy came back. This recession was so long and so wide and so deep that it took a heck of a long time. It took the best part of 10 years to get back to where it was. This one is much shorter and deeper. The 10-year rate, last time we talked earlier in this year, we could see 10-year rates picking up from about 1% to 1.5% to 1%. They've essentially been flat the last almost month and a half. And again, I think it's the Treasury market not quite sure, if and when the Fed's going to cut. Most people think it's not till they might talk about backing off on easing later on this year and do a cut in 2022. I think that's the kind of market consensus that makes total sense. But the market in the 10-year Treasury, which is very inflation sensitive, hasn't moved up. And I think this kind of range of 150 to 170 is pretty much what we're going to see for a few months. I know I might be pushing my time limits here, so I want to just move on to the stock. I'll talk about this one very quickly because there is, right now inflation, Treasury rates are negative. So we have 1.5%, and we've got a headline rate of 3%. So guess what? You don't make any money if you're measuring against the CPI by holding treasuries. They're not creating a real rate of return. One reason why we backed off the treasury market recently. But negative rates pop in and out. Back here, they were a giveaway. This is where you wanted to be a borrower, not a lender. But this is where you went out and bought as much of a house as you possibly could because you were getting negative rates of 5%. You could not help but make money in the property and real estate market. And then it was the same here in 79. Then inflation dipped down, rates went skyrocketing. So real rates were, very much a thing for the best part of 35 years. Then they started to dip down in this period where occasionally rates were popping up, inflation was low, you got a positive rate, and so on. You can see this kind of inverted W up here. Right now, I think that they're yes, they're negative. Probably not a great time to lock into a 10-year Treasury rate at 1.5% while you're at 3% inflation. But I don't think they're going to head on down. That would require the 10-year Treasury to be completely oblivious to the inflation rate if it does start accelerating, and I really don't think that's going to happen. So again, we're kind of going through these concerning times, but looking ahead, I don't think they're going to be permanent. Treasury rate, Treasury bond at 1.5%, no bargain. But it would be if we got into a deflationary time. But we got to kind of get this inflation hump, go through the other side of it. Good thing on the market, this is the equal weighted. So this is versus the S&P 500. So the S&P 500 obviously was doing really well in 2020, led by the large caps, which had about 10, 15 stocks for 30% of the market. Now it's broadened out much better, and this is the average. So the average stock has gone up, since this period about 42%. So this is much better. It means that here, Apple, Microsoft, Facebook, those guys, instead of being 30% of the market, they're only about 2% of the index. So, so this is a much better indicator of how broad the recovery is. So when you see the equal weight outperform the cap weight, it means that the kind of benefits or the breadth of the bull market is much better. So it's not just accruing to one or two leading companies. So that's been a very good story to have. They come back to is the market expensive? Yeah, it's expensive. I mean, it's very difficult to sort of come out and say this is a bargain. Now, it briefly was last April, May, and it has been at other times during corrections, but these openings haven't been open for very long, and it was a huge bargain back in 2009. So right now you do have companies. The average S&P company makes a 20% return on equity, which is incredible in a period of low inflation. You stick that number on the average Japanese company or the average German company, the average French company, is going to be less than half of that. So American enterprises, because of the mix of the industries they have, better run. Pick your reason, but 20% ROE is pretty astounding, and they've come from a incredibly low level about a year ago. The enterprise value EBITDA, which takes away some of the accounting anomalies that you get with price earnings ratio, again, no particular bargain. A little bit less than they were in the middle of last year, higher than they were for this decade. But they're not screaming off the roof. They're not, they're not like they were. Just take this back, the number just goes off the chart for 1999 and so on. And companies are generating plenty of cash, so these have been quite good. But yeah, I mean, I think of the S&P 500 as an extraordinarily good financial health, business health, margins, demand is strong, so the prices are not as cheap as we would like them to be. So we're kind of a stay put market rather than fill your boots. And this is one other variation we use on the valuations. There are so many ways to value the stock market. I mean, literally hundreds. There isn't a single one which will give you, an answer. Although the cyclically adjusted price earnings ratio from Schiller is pretty good, but none of them really tell you much about timing or how long the overvaluation is going to happen or where you are in the bargain rich cycle. But this is pretty good. It just tells you the earnings yield, less the 10-year bond, and you can see we're at about 3%. It's not too much different from what it was for about 6 or 7 years. It's the lower this number, the more expensive the stock market is. So again, huge bargains to be had in 2008, huge bargains at the end of 2011, briefly last year, cheaper than it was for most of this decade for sure. So those are some of the things we're looking at. So anyway, we are on reopening track. I think, I said this before, it sounds like I've kind of moved it a month forward every time we've met, but I do think we're, gradually reopening. I think where we made a forecasting error, not that it really mattered from a portfolio perspective, but we thought the opening up would be faster and quicker and more immediate than it has been, and kind of underestimated the caution that people have in getting back to work. And also, for employers, I mean, as you know, schools have been slow to come back, fully online, and even some of the ones which are opening up in September are doing the conditions attached. So the reopening is sort of, is happening. Consumers ready to spend, and we can't really open up the economy as quickly as we shut it. So I think gradually as things open up, we'll see more of this pent-up demand coming through into the final economy. The Fed's going to wait till they see the whites of their eyes of inflation. I'm pretty sure about this. I mean, 100% sure, no, but I'm not 100% sure about anything. but I'm very sure that the Fed will wait until they start seeing inflation numbers. They won't go on expectations. They won't go on University of Michigan consumer confidence surveys. They won't go on ISM, and they won't go on the NFIB, which is out today. They'll go for, is it hitting these types of prices and goods in a consistent way? And can they distinguish between the transitory and the temporary and the permanent? That's a tricky thing, but I still think they'll wait till the actual numbers come through, and they'll be definitely tracking wages. There's not much for them to track right now. The wages are not really showing any big uptake. Labor supply will come back. These stories about people not coming back to work because they're on unemployment benefit are pure nonsense. There's plenty of supply coming back. I think the major reason that people have not come back is because the jobs are not easily locatable. Public transport still running way below its normal capacity. Child and healthcare and home care is not where it needs to be. So this will take a while to get back into balance. By the way, the Fed, just so you know, they are not going to cut rates first. It's the last thing they're going to do. First thing they're going to do is stop reinvesting the coupons from the $4 or $5 trillion asset portfolio, which they have in mortgage-backed securities and treasuries. They've been reinvesting those into the market in addition to the 120 billion which they're buying. They'll stop that first, then they'll taper the 120, be a number lower, and then they'll cut rates. So there's kind of very much at least a three-step phase before they actually get to a rate cut area. And the market still has some bubbles. I mean, I wouldn't go buying electric vehicle stocks right now. I think some of the SPACs have gone crazy. Crypto, obviously an area which is incredibly volatile, and it shows that there's still a lot of money there. Some of the more pandemic-related stocks, that are not actually making money. So the Zooms, the DoorDashes, and Ubers and things like that, have probably looked very rich and some bubble territory. And then obviously the meme stocks, AMC and GameStop. I've written about that. It makes sense in a bizarre way, but obviously not something you want to tangle with, because when that market goes into reverse, it'll hit with a big thud. But otherwise, I think the general market is generally in relatively good shape. Gosh, I've gone way over. So let me make sure that we might have some questions here. Maybe not.
Yeah. Hi, Christian. This is Carolyn. Just check the Q&A. We have 3 questions waiting for you.
Okay. I'm on the wrong thing. Let me just check that. Stop share. Q&A. There we go. Okay. Sorry about that. Many people are scratching their heads about the don't worry about inflation talk, because they're experiencing real hidden inflation driven by soaring costs of healthcare, education, housing, even with lower rates. This is real cash out of pockets. What would you say to them? I would say, you can't not worry about inflation, because there's inflation from the policy rate, which is the CPI and the PCE, and then there's the inflation which you actually live. So, for people in healthcare, or rely on a lot of healthcare outside of an employer plan, it's going to be a number that's higher than inflation. Education, I mean, certainly, college. Private education seems to be on its own track of being almost double the rate of CPI. Housing, I think, will ease off. The rates, the mortgage rates bottomed out about 4 or 5 months ago, and I think some now the prices have moved too fast, too quickly. So I think those will level out. Although I know that especially in Marin. Bay Area, it's kind of a market all of its own. That's because the state of California basically keeps the supply side absolutely throttled up, so that the supply never gets a chance to meet demand. So I'd say that in individual cases you're going to see inflation depending on your type of living, but I think for the economy as a whole, it's going to be this spike up for the next few months, and then it'll eventually sort of come back into a much more moderate number. The 2% and 3% we've seen mostly for the last 30 years. Given the 10-year yield outlook, tight spreads in credit, what's Australia's BNG recommend for income investors or investors who need ballast? Yeah, right. Treasuries at 1.5%. Right now, there's I know the high yield market's very, very tight, about 4%. For those of you who don't follow this, that means basically that a high yield bond, which is a junk, it means it's got very bad financials. Will pay about 4% more than a US Treasury, and the normal spread's been more like 7 or 8. So, that's something which, if you grab onto, is going to give you a pretty wild ride. So I think one of the things that we're looking at, we've been investing for a while, is there's still some good, corporate credit. It's not going to be huge numbers, but there's going to be very good borrowers, and they're quite expensive, but they're not out of this world. But one of the things that we have been doing for about 9 months now is going into various parts of the real estate. No, not office real estate, but other specialist parts of the real estate market, where you get a very, very modest capital appreciation, because a lot of these businesses properties simply don't transact, so they don't have very good comps, or if they use a comp, they use a discounted cash flow system. But certainly we've liked some of the rents and rent increases that we've seen on that. So we particularly like companies or types of properties, real estate, where the rental lease agreements are reset pretty often. So office is like 7 or 8 years, with housing so yearly, and industrial and medical and stuff like that is somewhere in between. So those are pretty good income vehicles, and there shouldn't be much capital volatility. What's your view on real estate? Oh, there we go. Okay, so I kind of I don't see real estate as geographic. I see it more as a sector. So I think we push this idea around here a lot. We like the senior housing, we like the student housing, to go into it another day if you want, but industrial for sure, because these, when you used to press a button to get your stuff in 3 days, and then 2 days, and then 1 day, and then same day, and then before you even thought about it, you need it. What happens is that the logistics chain gets more complicated, and the number of warehousing spaces multiplies exponentially. I mean, literally in the old days, those of you who've driven across country, find somewhere in the middle of Omaha, there's a huge JB Hunt, FedEx, UPS, terminal. I don't know how to describe it. It's as big as an airport, with just logistics coming in from both sides of the country and being fed off to to where it needs to go. Well, now with the kind of more spot delivery, those warehouses are getting more smaller, but they're getting more specialized, and they're nearer to the to the end consumer. So it's if you're moving furniture around the country, you need, I don't know, 3 warehouses. If you're moving fresh food around the country, you probably need like 6 or 7. So that's been a good sector for us to be in. So has data storage, which is just basically a cloud computing play, but kind of interesting. And I don't know if Rita's on the line, but anyway, so there are some sectors that we think have done pretty well. I mean, they're not soaring. These aren't sort of big bubbles, but I think they're very predictable and pretty good sectors generally. Geographically, my only sort of broad hint would be not particularly original, is the Southeast tending to outperform everywhere else. See, as they've got the population growth on their side. Good. So I hope I haven't kind of rushed through those too quickly. I really appreciate everyone's patience. And the slides will be available up on the website. And thanks very much. And any other questions that you have, feel free to send us an email or just to the general number or your financial advisor. And we'll see you next month. Thank you very much. Should I read the disclosure?
Sure, go ahead, Christian. My recording isn't quite working.
Oh gosh, I get to read the disclosure.
Lucky you.
Lucky me. Here we go. Okay, how many people are leaving us right now? Here we go. Discussions of the investment strategy, research, investment process of Brown Janikowski or other date indicated of the date of this presentation, subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure that the type of investments mentioned in this presentation produce the intended result or outperform other investments in the future. We reserve the right to change our investment perspective and outlook without notice as market conditions dictate. As additional information becomes available, diversification does not protect an asset investor from market risk, does not ensure profit. The information is subject to unintentional errors, omissions, and changes. Without notice, all sources are from facts unless otherwise noted. While we gather this information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in this presentation. References to an individual security should not be considered as a recommendation to buy or sell that security. Securities noted in this presentation are only several of the successful and unsuccessful investments by Brown Janikowski. Don't represent all the securities we have purchased, sold, or recommended. Index returns include reinvested dividends and interest, but do not reflect commissions or transaction costs. Mutual fund returns include reinvested dividends, capital gains. Mutual fund returns are net of the fund's expensive. They do not reflect Brown Janikowski's fees. Please read the prospectus carefully before investing or sending money. Past performance no guarantee of future results. We may reference various hypothetical investment illustrations. These for illustration purposes only, not investment predictions. Do not guarantee indication of future results.